You find that horizontal mergers. That we have the vertical. The vertical is when you acquire another business which is doing, or the core principal activities of the other company is totally different. It's totally different. That one we call what? The vertical. That one we call the vertical. That is mergers and acquisition. Advanced financial management, you don't need to know a lot of theory, just know definition, the types of mergers and acquisition, and eventually know how to answer the questions. So we look at the concept which the examiner will like to test, the concept which the examiner will like to test, the concept which examiner is. So we need to understand the exchange rate. Number one, we need to understand the exchange rate. The exchange rate. So what is an exchange rate? What is an exchange rate? What is an exchange rate? So the exchange rate is simply what? It is the proportion of what? It's the proportion of over price by what? It is the proportion. It is the proportion of what? Over price against what? Against the market price per share of the acquiring company. Remember, you need to know the term called a predator. A predator. So when we say a predator here we are referring to the what? The acquiring company. The acquiring company. The acquiring company, or the company which makes the purchases or the acquisition, we call it the predator. That is the acquiring company. Then, what is the formula of exchange rate? What is the formula of exchange rate? So to get the exchange rate, my good student, we take the over price. Take the over price in bracket. In bracket, you can call in bracket. You can call DOP or non-diluting EPS. So when we say non-diluting EPS, you see, when you say we are diluting the EPS, or remember the company has what is called the earning per share. The shareholders have to be paid at the end of each of the financial year. That is, you pay the shareholders based on the number of shares they have. So if there is any other factors or any forces that may face the company, then for non-diluting EPS, it will not change. It will remain the same. It will remain the same. That one, it will remain the same. So you can give definition and say it is the price that safeguards. It is the price. It is the price that safeguards. That safeguards. It is the price that safeguards the earning per share, or the EPS of the company. The EPS of the company. Another point under that not diluting earning per share, you say it will not hurt to dilute of the company. It will not lead to dilution. It will not lead to dilution of what? Company EPS. It will not lead to dilution of the company EPS. That is the earning non-diluting EPS. So this non-diluting EPS, sometimes we call it the overprice. We call it the overprice. So let's get the formula of this non-diluting EPS. How do we get this non-diluting EPS? Remember we said how to get the E ratio of, we must compare to, if you are this to the ratio of what after getting one